Good afternoon and welcome to the third webinar in our succession series focusing on exit options. If you've missed our first two webinars around inheritance tax reliefs and succession planning and inheritance tax planning and pensions, the recordings can be found on our website within our new succession hub, along with a lot of other useful content around succession. Now on to today's webinar. With the fundamental changes to the IHT regime covered in our previous webinars, it's highlighted the greater tax risks on business owners who might hold a significant amount of their personal wealth in the shares of their business. As a result, succession planning is essential to navigate the changing tax rules and ensure business continuity is maintained going forward. My name is Matt Wilmot and I'm a partner in the corporate finance team here at PKF Francis Clark. Along with my colleagues from our tax and corporate finance team, we'll be discussing the various exit options available to business owners, covering both the tax implications as well as some of the broader commercial considerations in developing a succession plan. Now we've got quite a bit to go through, so we'll do some brief introductions and then we'll jump straight in. So should we start with Nicola, please?
Thanks, Matt. Hello, I'm Nicola Mann-Clark. I'm a tax partner here at Francis Clark, specialising in transactions such as management buyouts, employee ownership trusts and trade sales.
Thanks, Nicola. Rachel?
Hi, I'm Rachel Addis. I'm a director in the tax advisory team, focusing on owner-managed businesses, so advising on tax aspects for individuals as well as businesses.
Thanks, Rachel. And Tom?
Thanks, Matt. Tom Hicks, director in the M&A team here at Francis Clark, so kind of advising on company sales, acquisitions, private equity, and all things succession, really.
Thanks, Tom. So just a note to the listeners, if you've got any questions, please do ask them as we go. We'll try to answer as many as we can and pick up any at the end. Any we don't get to, we'll probably try and come back to you separately. So I'd like to kick off with a poll question, first of all. So for those listeners, have you considered your business exit plan already? Have you got a plan in place? So if we get that poll up, and then whilst people are doing that, we'll move on to our first area of discussion. So I suppose why is it important to have a succession plan in place? So Tom, do you want to kick us off from that?
Yeah, thanks, Matt. So I think probably now more so than ever, having a clear strategy for what your transition of ownership looks like is very important. For many SMEs, that can often involve passing the business on to the management team, which could well be family members or otherwise by way of a management buyout. You could look to sell the business to your employees by way of an employee ownership trust, which we'll touch on later, or to an external third party by way of a trade sale. But I think whichever route you choose to look at, I think having a proper strategy as to how you're going to execute these transactions in good time will help ensure you maximise the value and return to the shareholders and mitigate the risks that can arrive with kind of an unplanned exit. At the moment, we've obviously got the upcoming IHT changes, which we'll touch on later. So having that plan in place to ensure you can execute what you want to do in time is clearly very important. And doing nothing should only ever really be a very conscious decision. Make sure you're aware of what options are available to you and the business, and make sure that is the right fit.
Thanks, Tom. I guess in terms of looking at it in a slightly different way, then if there is no succession plan in place, what are some of the things that could go wrong? What are some of the risks that business owners face? So Rachel, do you want to tackle that one? Sorry, Rachel, you're on mute.
Sorry, thank you. So yeah, if there's no succession plan in place, then it can mean that there's no security over the ownership of the company. For example, if you've got an unplanned exit with a disagreement or a divorce or death. I mean, unfortunately, none of us know how long we're going to be here in life. We don't know what's going to happen in the future. So we can only plan as best we can. So if you don't have a plan in place, then your family could potentially be left holding shares in a really valuable company with no way of actually paying the inheritance tax on those. Or you could make a gift of shares, but unfortunately not survive the 7 years following that gift, and then inheritance tax is still payable. Or you could be in the position where you've disposed of your business and you've got a huge amount of cash, but you haven't taken advice on how to invest that in a tax efficient manner. So all these scenarios are things that people are considering a lot more now following the changes to inheritance tax and the business property relief rules. So I've just popped up on the screen the changes, the key changes really, that have been discussed in detail in our previous webinars, because I thought I'd look at sort of the corporate side of things. So currently, if you've got an individual that passes away owning shares in an unquoted trading company, then they can get 100% relief from inheritance tax because they should qualify for business property relief. So that's a huge saving because the main rate of inheritance tax at the moment is 2%. From next year, so from April 2026, it's changing so that only the first £1 million worth of shares would be inheritance tax free by claiming the 100% relief. After that, the balance is subject to just 50% relief. So effectively, you'd be paying 20% inheritance tax on the balance. So if we just look at some numbers, just to quickly put that into perspective. If you've got hold shares in a trading company that are worth £6 million, if you died today, there would be no inheritance tax payable by your family on those shares. But if you had passed away this time next year, then the first £1 million would be inheritance tax free, but the balance of 5 million would be subject to inheritance tax with a reduced relief. So your family could end up paying £1 million of inheritance tax. Now, I've ignored any nil rate bands, but as you can see, the difference is huge, and that could be really crippling for your family. So planning is really key, and that's what we're just trying to get across, really, that any plans, they need to be considered but not rushed. They need to achieve your goals, and hopefully you'll see by this webinar, I mean, there's so many different options and there's no one size that fits all.
Thanks, Rachel. I think sort of the key bit there, I think, is drawing the sort of link between what is a potential personal liability to something that could well fall upon the business and threaten the business. If the beneficiaries need to raise the funds, then clearly, do they use the shares? Do they have to sell the shares? Do they have to get money from the business? So it quickly comes back to the business if there isn't a plan in place. So just going back to our poll, so what everyone's saying is 40% of our respondents have a plan, 60% don't. So quite a few people there still needing to think about that. Okay, so let's just move on now into when someone's looking at the succession options. Clearly, tax is one factor to think about here, but it's not the only factor by a long stretch. So, Tom, what are some of the key factors that shareholders and business owners might want to think about, and that might direct them to particular options over others?
Yeah, thanks, Matt. So I think the shareholders themselves need to think about what their objectives are and what they want to get out of the transaction. Is that purely maximizing the value they can get for the business and ensuring they maximize the amount of cash they receive on day one, or are there kind of other factors at play here where some people in verticals don't want to sell to the devil? They don't want to see their business in the hands of a competitor, or they really want to see it in the hands of their management team. So thinking about what type of transaction you want, regardless of which route you choose to go down, somebody's going to need to run this business going forward. So have you suitably distanced yourself to allow a successful deal to happen? Is there a suitable management team in place to continue running the business? Your legacy, lots of people find that a really critical factor. Want to see their legacy carry on through the new ownership. Think about when you're going to go to market. How's the business performing? There's things within your control. You want to sell a business when it's trading well, maximize the value, but also external factors. Not sure anybody's going to try and second guess what's going to happen in the economy too quickly, but think about that and the timing of taking the business to market, but also what other opportunities are there in the sector you operate. Again, can contribute to the timing and which route of the transaction you look to go down.
Thanks, Tom. So I think it's fair to say that there's financial elements are critical here, and that includes tax, but clearly there's a lot of sort of personal objectives as well, family objectives, and also how does all this fit in with the business and where it is in its life cycle. So now we're going to jump into a bit of the detail in terms of specific options. Nicola, do you want to give us an overview of, I guess, what we'd call the main options available to business owners?
Yeah, thank you. So this is an introduction to the main kind of topics and options that we're going to be exploring today. So first of all, gifting some shares, so maybe to a family member or to a trust. A company purchase of own shares with the company itself, buy back the shares from one or more of the shareholders who wish to exit. Management buyout, where the management team take over the control and ownership of the business. Employee ownership trust, which is a special kind of employee benefit trust, which buys the shares to hold on behalf of the employees. A third-party sale, which is fairly self-explanatory, and then finally a members' voluntary liquidation, where the company is liquidated and the assets extracted.
Thanks, Nicola. So we've tried to sort of boil it down to sort of 6 options, but I think the reality is each situation and scenario is going to be unique, and each shareholder composition is going to be different, and therefore, there may be combinations, so there may be different nuances that are going to be relevant, but we're just trying to cover the sort of main concepts in terms of the transaction types. Right, so if we focus in on gifting shares, first of all, Rachel, do you want to give us an overview of that?
Yeah, thank you. So if individuals want to pass on their trading company to family members, for example, and they don't want or need any cash, then gifting shares could well be the right option to take. And there's 2 routes for this. There's direct gift of shares and also gifting into a trust. So the starting point is that a gift of shares will be a disposal for capital gains tax purposes. Despite no cash actually being received because it's a gift, the disposal proceeds will be deemed to be market value. So the individual's gifting could actually have a CGT bill with no cash to pay for this. So how do we mitigate it? Well, the individuals making the gift could enter a joint election with the recipient for gift holdover relief for business assets, and shares in a personal trading company are qualifying as a business asset. So as the name suggests, this works by holding over the gain that would have been crystallised had the relief not been claimed. So essentially the recipient is taking on the donee's base cost, so that no capital gains tax will arise on the gift, and it will only arise when the recipient then goes on to dispose of their shares. So I've mentioned that the election applies to shares in a trading company. Now, on the face of it, a huge number of companies appear to be trading, but it's only when you delve into the detail of the balance sheet that it could show that a company holds non-business chargeable assets, so like investment properties, for example. And in that case, gift relief will actually be restricted so that there will be some capital gains tax to pay. So we just need to look at that when we're thinking about gifting shares. And as well as capital gains tax, we need to consider employment-related securities legislation. A bit of a mouthful, but essentially it's where individuals are employees or directors and they're the ones receiving the shares. So HMRC would expect those individuals to pay market value for their shares. But there is an exception if there's a family relationship. So for example, where we've got parents gifting to children, then that would be outside the scope of this, even if they're employees. And finally, just some brief considerations on inheritance tax, because I know these have been covered in detail in previous webinars. But a gift of shares is a potentially exempt transfer. So provided that the donor survives 7 years, then the gift will fall out of their estate for inheritance tax. Where that isn't the case, then the value does drop back into the estate, although you will have some tapering and you can apply the business property relief as well. In addition to that, you can also take out insurance to cover the potential inheritance tax on a gift, if that is a concern that you may not survive the 7 years. And our colleagues in our financial planning team are able to help with that. So just moving on to a gift of shares into a trust. So where you've got a direct gift, there could be concerns about relinquishing control to family members or children having the shares. And in that case, a trust can be really helpful because the shares can be gifted into a discretionary trust and the donors can then appoint themselves as a trustee of that trust. Again, with capital gains tax, there's holdover relief that's available on the gift into a trust with not the same restrictions as there is on a direct gift. From an inheritance tax perspective, the gift of shares into a trust is a chargeable lifetime transfer. So where the value of the shares gifted into that trust exceed the nil rate band, which is currently 325,000, then there is an immediate inheritance tax charge at 20% on that excess. The 7-year rule about surviving 7 years from the date of gift applies here as well. So the same considerations need to be taken into account whether insurance might be a possible option. And trusts, generally, they have an inheritance tax charge every 10 years, where the trust is valued at greater than the nil rate band. So just something to be mindful of, but trusts can work really well depending on your circumstances.
Thanks, Rachel. And I don't think we'll speculate as to whether any of this will change in the budget, but I won't ask you unfair questions like that. So we'll skip on to the next option that we listed. So company purchase of own shares. So what are the scenarios this works for, and what are some of the details that people need to be aware of, Rachel?
Thank you. So a company purchase of own shares, it can often be the route that's considered if you can't find an external buyer. So what is it? So this is where shareholders return their shares to the company in exchange for cash. So of course, if you are the sole shareholder of your company, then this option isn't going to work, but it could do after you've gifted some shares. So it could work in connection with the previous option. Now, the default tax position is that the individual receiving the money from the company for their shares is treated as if they've had a distribution. So they'll be treated as if they've had dividend income, essentially. As with most options, there are conditions that need to be met to carry out a share buyback. So the company's got to have sufficient distributable reserves to fund the buyback, and the shares need to be acquired for market value to prevent any additional tax charges. Now, when I'm talking about market value, this is quite a key point for this option. For a company purchase of own shares, the market value is the shareholding when taking into account a minority discount. So that's quite a key difference to then when we look at a management buyout, which Nicola will come on to in a minute. That's the difference in the valuation between the two options. Here, the company's got to have sufficient cash reserves as well. So the consideration for the shares has to be paid in full in cash on completion. So you can't extract assets, for example, as part of that consideration. It's got to be cash. The cash can then be used after completion to potentially buy assets from the company. And then moving on to the consideration, I've mentioned that the default position is that it would be treated as dividend income for the disposing shareholder, but if certain conditions are met, then it will actually be subject to capital gains tax instead. Now, I haven't gone into all the detail on what the conditions are. I mean, I'm very happy to discuss those with anybody where this is a potential route, but we can apply to HMRC to get their agreement that the conditions are met. And we would suggest doing that because you would want comfort that your proceeds would be subject to capital gains tax instead of dividend income, where the rates for dividend tax are much higher.
Brilliant. Thanks, Rachel. We've had a question, so I'll just flag. So if anyone wants to ask a question as we go, please do. So the question is actually back to the sort of trust section. So could a discretionary trust be broken and the shares transferred to the beneficiaries after 7 years without an IHT charge?
That's a good question. Yeah, so trusts can be broken. I would have to look into that and we'd have to come back to you separately.
Fine. So it sounds like individual specific circumstances there.
Yeah.
So we've now had a question on the company purchase of own shares. So can the buyback be done each year as company cash reserves allow, and does the company have to pay stamp duty on the buyback?
So where it depends on what we're looking at with a company purchase of own shares. If we're trying to get capital treatment, then the reduction in that person's interest in the company needs to be significant. So it needs to drop down a lot for capital treatment to apply. So again, we'd have to go through the different conditions to be able to look at that one on an individual basis, really.
Fine. It sounds like a sort of incremental one could be risky. I think that's what you're saying. Okay. So I think we're going to move on to our next option, which is management buyouts. So Nicola, do you want to give us an overview of where these are suitable and what are the key considerations?
Yeah, thanks, Matt. So this involves the structure that we're going to look at on this slide here, where the company is taken over by the management team and the existing shareholders sell that company to a new company. So there's a new company which will be incorporated by the management team. Yeah, and that new company then will buy the existing trading company and will pay the existing shareholders consideration for that, which usually comes in various forms. So that's kind of what the structure looks like. The main objective for this is really to secure the succession of the business for the management team. So it secures an exit for the existing shareholders without a third-party sale, which for them gives them more control over the process, and also helps with the cultural continuity and some of that legacy as well that Tom mentioned. It's also a relatively quick transaction as well compared to a third-party sale. A key here is it hopefully motivates and incentivizes the management team or the family members that they're taking on as part of that management team, and keeping the business in sort of familiar hands. The exiting shareholders can still retain some shares in the company, so as part of the consideration they can receive new shares in that new company. So provided their interest is a minority interest, they don't retain control, then they can then benefit for some of that future growth potentially for another exit in the future. There's no minority discount applied to the valuation of the shares. So as Rachel mentioned, on the company purchase of own shares, if the company's buying back a minority interest, then the value of that shareholding will be lower than that percentage of the company as a whole. So here you've got 100% sale of the shares to the new company. So the exiting shareholders will receive 100% value essentially. It can be quite flexible in terms of the types of consideration that the shareholders receive. So typically they might receive some cash, because that will be whatever cash is available in the business, or sometimes funded by a third party. And then some deferred consideration in the form of loan notes perhaps, or preference shares. And then as I said, they might retain some ordinary shares as well for the future. So in considering a management buyout, some important considerations here. So usually getting HMRC clearance will be recommended. So that's to try and ensure that certain anti-avoidance provisions don't apply. You need to have a genuine commercial reason. It needs to be a genuine succession plan for the business, not just a strategy to extract cash by the existing shareholders. You usually need evaluation, so those employment-related securities rules that Rachel mentioned, they can potentially apply if you've got some value shifting, so it's usually best to agree an evaluation. And then also the management team, although the whole of the value of the company will usually go to the exiting shareholders in those various forms of consideration, the management team will typically need to pay something meaningful for their shares, even though it doesn't need to represent the proportion of the value of the existing value of the company. So capital gains tax, the exiting shareholders should receive capital gains tax treatment on the sale. So there are different types of treatment for the different types of considerations. So some of that gain might be rolled into the loan notes or preference shares or ordinary shares, for example, whereas the cash consideration would crystallise a part of that gain up front. And then to consider inheritance tax, so any cash or loan notes that you receive, they then won't qualify for any inheritance tax reliefs, but any share capital that the exiting shareholders receive, like the ordinary shares or preference shares, could still potentially qualify for business property relief. And again, you could look at options such as insurance that Rachel mentioned before about the illiquidity of those shares of an inheritance tax charge should arise post 2026 for those reduction in the relief of business property relief. Okay, thank you.
Thanks. I was just going to add from a from a kind of corporate finance perspective, one of the kind of most common things we hear from a management buyout is, oh, my management team couldn't afford to buy the company, which isn't always true. The management team themselves don't have to come up with the cash to pay for your shares. As part of the transaction, they'll often go out and seek external finance to help fund these deals. So the consideration, like Nicola said, it's hugely flexible. We can get some external finance, we can just defer some of the consideration. So the beauty of a management buyout is that flexibility. We can often make something work that works for everybody, and very quickly. These deals can happen quite a bit quicker than a trade sale if you are trying to get something done before a particular date. And I think the only other point I'd mention is, from a confidentiality perspective, a management buyout is quite nice in that it keeps it all under one roof. You know the people you're speaking to. You're not going out into the market to sell your business. Confidentiality is obviously a big piece within a trade sale, which we try and make sure confidentiality is maintained, and it often is, nearly always is. But for certain individuals, they like the fact it's all kind of under your control within the business.
Thanks, Tom. I think I'd re-emphasize that flexibility on that one. I think particularly if you've got a diverse shareholder group where some want different things, some might want to get out, some might want to continue. An MBO can be quite flexible to meet different individuals' objectives. So you can have some exiting, some remaining, more management coming through, and it's a great incentive tool to drive the business forward. Great. Okay, so quite often when we have these conversations with business owners regarding MBOs, the next conversation tends to be on EOTs. What's the difference? Which one's best for me? Nicola, do you want to cover EOTs?
Yeah, thank you. So transition to an EOT as part of the succession plan and really can suit the business and shareholders, where the owners really want to secure the long-term succession of the business for the benefit of the workforce, and again to secure their legacy, to keep the culture. And also it's another form of exit without needing a third party as well, so it tends to be so quicker and easier as well from that perspective. This just shows the sort of structure here. So in order to transition to an EOT structure, there'll be a trust which is set up, a type of employee benefit trust, which is for the benefit of all the employees. And that trust buys the shares in the company. It has to acquire a controlling stake, and then it's the trust which is then the main controlling shareholder then, which holds the shares on behalf of all of the employees. So the employees don't have direct ownership as such. Yeah, one of the key benefits of employee ownership trust is that the tax treatment, and that is that there's a relief for 100% of the capital gains tax for the shareholders on a sale to an employee ownership trust, which is obviously a very beneficial relief, and there's no inheritance tax either on that transfer. There's also a cash bonus facility to be able to pay employees of up to just over £3,500 a year tax free. So there are lots of great kind of tax benefits of this succession plan. It is really important though to emphasize it's not just about the tax. The structure can be really transformative for businesses, can really improve employee motivation and retention, but it doesn't suit all businesses, and it's really important to explore whether or not it is the right succession plan for your business before embarking on any process. And as Matt mentioned, we do have a lot of conversations with business owners about the different types of succession plan, and is this right? And it might often be between an MBO and an employee ownership trust, and kind of exploring which will work best is really important.
Thanks, Nicola. I think linked to these sorts of transaction, MBO versus EOT, funding is a key aspect to that. And I suppose a feature of employee ownership trusts are you can raise debt into those sorts of transaction, equity not so much because the trust is going to be the shareholder, but but they tend to be structures where shareholders will have to wait a little bit longer for their money in terms of the IOU from the trust to pay for it. So if you've got high value businesses that are being valued on very high multiples, those timescales can probably be slightly prohibitive. And I think as you said, Nick, in terms of the management team, clearly incentivizing the management team, those that are key to the decision making and the leadership of the business, is absolutely critical. And that's often a comparison between the MBO and the EOT. Management with equity, how hard are they working to drive their own personal growth in value? That's not to say you can't incentivize people in EOT, but it's a different approach, and that's a key consideration. Great. Okay. So now I think we're moving on to our fifth option, which is trade sale or third-party sale, which will also cover private equity sale. So, Tom, do you want to kick that off?
Yeah, thanks, Matt. So a trade sale or third-party sale is the most common transaction type for us. So that is the sale of a business to a third party. And that third party could be somebody already in your industry or sector, whether that be a competitor or somebody with a complementary product or good or service, or somewhere on the supply chain. Or an alternative to that could be the sale to a family office, which we're seeing more and more of, particularly with overseas interest. So that is somebody acquiring your business, will largely let it run on its own, and you are effectively accumulating wealth for that family, or sale to private equity. Private equity can get a bit of a bad reputation in the papers if you go to the wrong ones, but it can be a great option to help drive growth within a business. I think whichever route you go down, kind of a bit of repetition of what we touched on before, but planning early and making sure you have a strategy to deliver this will help maximize value for you as shareholders. So it comes back to having that plan on how you're going to execute it. Nicola, do you want to kind of touch on the tax pieces?
Yes, of course. So typically third-party sales, so the shareholders, owners will be selling normally the entire share capital of the company. The types of consideration they receive will usually be cash in one form or another, or sometimes there can be an element of rolling into shares or loan notes, but usually it's cash in one form or another. And typically it will be some upfront cash, but then perhaps some deferred, often in the form of an earn-out, which are future payments which depend on the future performance of the business. Earn-outs do have quite a complicated tax treatment, and you usually need specialist advice to help with those. We do spend quite a lot of time advising on earn-outs and what that means for the shareholders. Any property extraction, so again, this is something that we talk to business owners quite a lot about. So there's valuable property within the company, so it might be a freehold trading premises, or there might be some investment property. Maybe the buyer doesn't want to pay the value for that property, and or you as owners, you want to keep that perhaps for an investment for the future. Working out the best way of extracting that property in as a tax efficient way as possible is something that we like to have early discussions with the business owners about. Then on the basic sale of the shares, then again, capital gains tax treatment there. So there's potential for part of the proceeds to qualify, or all the proceeds to qualify for business asset disposal relief. So at the moment, that is a rate of 14% on the lifetime gain of £1 million, which goes up to 18% from April next year. And otherwise the main rate is 24% for capital gains tax. And IHT, so again, this is a really important thing to consider in terms of inheritance tax planning. So your shares might currently qualify for business property relief. If you sell for cash and an earn-out stay, then that cash and those assets will no longer qualify. So it's really good to kind of plan ahead as to what you're going to do post-sale with those proceeds, and do some estate planning and take some financial advice as well.
Thanks, Nicola. I think when it comes to sort of third-party sales, in contrast to the other transactions, that element of having a third party involved in a process does mean that there will be scrutiny on the business, and I think fundamental to maximising value is that preparation. So, you know, as Nicola's mentioned, there's some tax things to think about to optimise the tax outcomes, but from a business valuation perspective, from a due diligence preparation perspective, there's quite a lot that will go into that, and that can take time. And I think, you know, across all of these options, starting early is fundamental to make sure you're getting the outcome that you want to achieve. So yeah, that process is a little bit more involved with a third party doing due diligence, etc. Okay, I think we're now on our final option around solvent liquidations, or members' voluntary liquidations. Rachel.
Thank you. Yes. So the final option is where you could consider a liquidation. So if the shareholders want to exit the business and there's no option for trading to continue under new ownership, or following a sale of trade and assets, for example, you've just got a company that's got a lot of cash in there, then you could consider liquidating it. For small companies who are solvent and have relatively simple affairs, then an informal winding up process could be considered instead. And that's where you just apply to Companies House to strike off the company off the register. And if reserves are less than £25,000, then the distribution to the shareholders could be treated as capital distribution. The more formal process of the members' voluntary liquidation can be used by larger companies, and especially where the reserves in the company are over £25,000, so the company is solvent. Our restructuring team at Francis Clark carry out lots of these because you need a licensed insolvency practitioner, and they act as liquidator who will realise the assets, pay off any liabilities, and then return the surplus funds to the shareholders. So there is, of course, a cost to liquidations that needs to be taken into account, but where the company has significant reserves and the liquidation is being carried out for commercial reasons, then it's normally the preferred route for tax purposes, because distributions that the liquidator makes to the shareholders are normally treated as capital. So, of course, as with anything, we've got the anti-avoidance legislation that needs to be taken into account here, but often this is much preferred route if you're looking to get capital out and the company is no longer needed.
Thanks, Rachel. That's a fairly sort of terminal option, but clearly in some circumstances the business has reached the end of its life cycle, then that may be a way of extracting value or cash from the business in the most tax efficient way. So I just want to put another plug in for questions if anyone wants to raise those, and also would like to launch our second poll. So of those options that we've mentioned, what is being considered by individuals? What might be relevant to their circumstances? Okay, so whilst those are counting up, let's go back to sort of the fundamentals then. So there's obviously a range of options here that we've discussed around the actual process, but how do you start developing your exit strategy, Tom?
Thanks, Matt. So I think, you know, for a lot of clients, it's actually sitting back and thinking and understanding what their retirement needs actually are. That can be from a financial aspect. You know, we work very closely with the financial planning team here to help model what retirement would look like, and therefore what needs to be realised by way of the transaction to help fund that retirement. You know, and to help make that possible, understand what your business is worth. You know, have a valuation performed, and understand what transaction options are available. that could be any of what we've spoken through today, but at least you should be aware of the art of the possible before making any decisions, and do that early. I mentioned earlier, think about the timing of your exit, both from a personal perspective, but also market conditions, both within your sector and from a kind of funding and M&A perspective. But also it's important to recognise, again, as we touched on, different shareholders within a business will have different objectives, and there will be transaction options available out there that do meet everybody's plans. So speak to us, understand what's available, and plan early would be the key things to take away from me, I think.
Thanks, Tom. So I think just heading over to our poll results. So it's quite a spread. So 35% are looking at gifting shares, 11% looking at company purchase of own shares, 17% management buyout, 6% employee ownership trust, 33% trade sales, so a third, quite a high proportion there, 10% MVLs, and then 25%, so a quarter undecided. So I think that's sort of quite clear that there's of those options we've discussed here, there's clearly a range of different things, and multiple options may be applicable to individual circumstances. So I think I would reiterate what Tom has said there. Is the first step is understanding which ones are appropriate in the circumstances, which meet the shareholders' objectives. Is that value, is that legacy, whatever those happen to be. Really get a good idea of what is relevant to you. I don't think we've had any further questions at this stage. So I think we're on to our sort of final conclusions, really. So for every business owner, understanding what their business is worth is a key starting point. And clearly, if they're going to undertake a transaction, what is that process going to look like for them? Is the business ready for it? Is the management team appropriate for that future succession of the business? Because that will often take a lot of time to get in place, regardless of any transaction, and that can often be a blocker for several options available to shareholders. Clearly, there's a lot of complexity in the tax policy and the outcomes for shareholders. Certainly, having a good understanding of that for your own personal planning objectives and your cash flow is essential, but there are often things that you can do ahead of a transaction to try and optimize that. So please do come speak to us if there are things that might be relevant to you. And as Tom said, these things do take a lot of time. Start early. It may be several years away, but there are things that can sort of restrict you if you do it too late, and you may find that you don't optimize the outcomes if you're not appropriately applied. So I think final remarks is that the slides will be sent around to the attendees, so some of that tax detail will come across to you. And finally, I just want to say thank you on behalf of all of us for listening in today. Thank you.